China's ambassador to Canada saying canola tariffs will be dropped if Canada drops its tariffs on Chinese-made electric vehicles.
Prime Minister to do exactly what Beijing has offered, which would be to drop the 100% tariffs on EVs in exchange for them to drop those 100% tariffs on canola products.
Canada has 100% tariffs right now on Chinese electric vehicles, and that's good for the Ontario auto industry. But China responded with tariffs on Canadian canola.
It began quietly, without headlines or breaking news alerts. While Washington turned up the pressure on Canada with tariffs and tough talk over autos and steel, a different voice reached out from across the Pacific. Beijing started opening doors, offering access to its markets, talking trade in energy, agriculture, and even the growing electric vehicle sector. For decades, Canada's economy moved in step with the United States, its largest and closest partner. But when the tariffs hit and tensions deepened, something shifted in Ottawa. Leaders began to see the cost of relying too heavily on one ally, no matter how familiar that bond had been. As China offered a new path forward, a question began to surface. Is Canada quietly realigning its future away from Washington's shadow? Tension between Washington and Ottawa reached a boiling point in early October. At a business forum in Toronto, U.S. Commerce Secretary Howard Lutnick delivered a sharp message that landed like a thunderclap. When it came to vehicle production, it would be America first, Canada second. The statement carried more than rhetoric. It was backed by the threat of a 25% tariff on cars and auto parts shipped from Canada into the United States. For Ontario, home to the country's auto industry, the warning struck hard. Nearly 500,000 jobs depend on that cross-border supply chain, a system so deeply intertwined that every vehicle built in Canada contains roughly half of its components made in American factories. For decades, the two economies had moved in tandem, but the tariff plan signaled the start of an unraveling. As the story spread, the markets reacted almost instantly. Ottawa's trade experts issued a stark projection. Billions could vanish from Canada's auto exports, setting off job losses across steel, aluminum, and manufacturing sectors. Even economists in the United States warned that the tariffs would raise production costs and cut into profits for American automakers. Yet, the Trump administration refused to budge. Washington's stance was clear: production should shift to U.S. soil, regardless of how much pain it caused across the border. That moment marked a turning point for Canada's economic direction, one that would lead its policymakers to quietly rethink decades of alignment with their southern neighbor. For years, Canada had followed the American lead on trade issues, even echoing Washington's tariffs on Chinese electric vehicles. Yet instead of being rewarded for loyalty, it found itself on the receiving end of new penalties. The Trump administration viewed trade less as cooperation and more as competition. While Washington tightened its grip, Beijing saw an opening. China began reaching out, signaling that it was ready to ease restrictions on Canadian agricultural exports and explore partnerships in clean energy and electric vehicles. For Canada, still facing Chinese tariffs on canola and other crops, the gesture mattered. Beijing's message was straightforward: open your market to affordable Chinese EVs, priced between $35,000 and $40,000 Canadian dollars. And in return, China would reopen its vast consumer base to Canadian farm goods. The logic was hard to ignore. Canadian farmers would regain access to a billion-person market, and consumers would gain lower-cost EV options, supporting the country's climate goals. The timing was also strategic. With the U.S. closing its doors to Chinese EVs through a 100% tariff, Beijing needed another foothold. Canada's growing frustration with Washington made it the perfect candidate. In Ottawa, the proposal sparked debate. There were clear economic advantages, but also the risk of angering Washington. Diversifying trade, however, was becoming less of an option and more of a necessity. Canada's leaders understood that the old assumption that economic survival depended on American goodwill no longer held true. China was not a replacement for the United States, but it offered leverage that Canada had lost. For the first time in years, Ottawa had a real choice. By mid-October, that shift began to take shape in public policy. Prime Minister Mark Carney's administration announced new funding for manufacturing and energy sectors, coupled with measures to protect industries threatened by U.S. tariffs. Ontario's Premier, Doug Ford, pushed for programs to safeguard auto workers from job losses. Canada also lifted some retaliatory tariffs to signal openness to dialogue, but it maintained a 25% duty on American-made vehicles entering Canada. The message was firm but balanced. Canada was willing to cooperate, but not to be cornered. Officials called the approach sectoral resilience, a plan that moved away from one large, sweeping trade pact towards smaller, targeted agreements with multiple partners. The goal was to spread economic risk and reduce reliance on any single country. That philosophy aligned perfectly with China's outreach. Canadian companies in the EV and battery industries were already looking to Asia for investment, while Chinese firms were eager to access Canada's reserves of critical minerals like lithium and nickel. What emerged was not defiance, but pragmatism, a decision to build strength through flexibility rather than dependency. Meanwhile, Trump's tariff campaign began producing the opposite of its intended effect. According to U.S. Department of Commerce data, prices for steel and aluminum had risen nearly 20% since early 2025. Vehicle prices climbed, factory profits thinned, and assembly lines in states like Michigan and Ohio started slowing down. Industries that relied on cross-border trade were feeling the squeeze. Economists from the Federal Reserve Bank of Chicago calculated that a 10% increase in tariff costs cut manufacturing output in the Midwest by roughly 2%. The broader consequences for Washington were becoming impossible to ignore. Instead of solidifying alliances, the White House had weakened them. Canada's engagement with China signaled that the U.S. could no longer assume its northern neighbor's unconditional alignment. Ottawa's shift was not an act of defiance, but one of survival. Confronted with rising barriers and diminishing trust, it chose to adapt. Canada diversified its trade routes, reinforced its domestic industries, and began charting a path that no longer depended on the goodwill of a single partner. That evolution is already visible in the numbers. Canadian exports to Asia are climbing, and ongoing talks with China hint at broader economic cooperation ahead. Within Canada, there is a growing awareness that reliance on one market, no matter how large, can turn into vulnerability overnight. Trump's economic policies, built on pressure and tariffs, have underscored an important reality. Strength in trade cannot be sustained through threats. While Washington measures influence by control, Canada has begun measuring it through options. And if the partnership with Beijing continues to deepen, the United States risks losing more than trade. It risks losing the trust that once defined its leadership across the Western world. The same dynamic is unfolding across the Pacific. Trump's trade strategy was designed to rebuild American dominance, but it is increasingly strengthening others instead. The administration boasts of billions flowing into the U.S. economy, yet its policies are driving some of America's closest allies to question their dependence. Long-standing relationships are fraying under the weight of protectionism. In Japan and South Korea, two of America's strongest allies, frustration has become impossible to hide. Decades of economic partnership are giving way to unease and hesitation. In Tokyo, officials have gone public with their dissatisfaction. Japan's economic minister recently stated that the trade deal with Washington remains incomplete. Although the U.S. agreed to lower auto tariffs from 25% to 15%, crucial sectors like pharmaceuticals and semiconductors remain unresolved. Without those, Japan insists, there can be no final agreement. Behind the scenes, tension runs even deeper. Washington has asked Japan to invest roughly 550 billion yen to help rebuild American manufacturing in shipbuilding and pharmaceuticals. From the U.S. perspective, it's an investment in shared prosperity. From Tokyo's view, it feels more like a demand. Policymakers fear that paying billions to secure tariff reductions would set a dangerous precedent, one that turns economic partnership into something resembling tribute. Japanese business leaders share those concerns, describing the process as rushed and lacking transparency. Until the details are clear, Japan refuses to finalize the deal. that resistance marks a rare and significant moment. It is one of the few times Tokyo has openly pushed back against Washington's realignment economic terms. The uncertainty is already affecting investment flows, slowing joint projects, and raising domestic political costs. Japan may risk losing short-term access to American markets, but the U.S. risks something greater: the erosion of trust from a key ally that has long been central to its presence in Asia. In South Korea, the backlash is even more pronounced. President Lee Jae-myung has taken a firm stance, declaring that no trade deal will be approved if it undermines national interests. The response from Washington was immediate and sharp. Officials warned that failure to comply would mean restoring tariffs on Korean exports back to 25%. Korean media framed the message as an ultimatum rather than a negotiation. The proposed deal involves a $350 billion investment in U.S. industries, but with Washington controlling the structure and profit distribution. The pressure has fueled resentment across Seoul's political and business circles. The tension escalated further after a dramatic raid earlier this year at a Hyundai plant under construction in Georgia. U.S. immigration authorities detained several members of Korea's technical team sent to oversee operations. The incident drew outrage in Seoul, with media describing it as a public embarrassment and a warning about the instability of American policy. Economists now say the raid left a deep scar on South Korea's confidence in the United States as a safe investment environment. Carney entered calm and measured, his statements grounded in data. Trump, confident but restless, spoke in bursts, shifting from one subject to another: cars, borders, even Venezuelan drug routes, without clear connection. He praised a crackdown on illegal fishing boats, then jumped to steel production figures, leaving reporters struggling to follow. When he claimed that $17 trillion of investment had entered the United States within 8 months, the statement was quickly questioned. The Bureau of Economic Analysis showed a far smaller figure, less than $500 billion for the entire year. That's all for today. Thanks for tuning in.